Good afternoon, everyone. My name is Max Clark, and on behalf of everyone here at the Fox Alliance, we are grateful that you have chosen to join us this afternoon as we provide to you guys our 2026 market outlook. There is a lot to cover today, so we are going to get started promptly here and just let you guys know that this will probably be a little bit longer conversation than our normal presentation. I'm expecting it'll probably be about 45, 50 minutes. But we are looking forward to sharing everything with you guys today. We do anticipate having a little bit of time at the end for some questions. So if you do have any questions that you would like us to address, we will do our best to get to them. You can send anything that you would like us to talk about to max@thefoxalliance.com. You can see that here on our on the presentation. Now, presenting today will be three members of our investment and finance committee. Josh Renfro, located in the Austin office. He is a founding partner here at the firm and our chief investment officer. We also have Laura out of our North Carolina office. She is also a partner here at the firm, and myself, Max Clark, located here in our San Antonio office and a partner at the firm as well. We are looking forward to reviewing everything with you guys. But before we jump into the details of our outlook for 2026, we wanted to cover a topic that we've gotten a lot of questions about. And it's certainly been something that has been on a lot of people's minds recently, and that has to do with the price of gold and silver. There's been a lot of movement on that front. And this has kind of been happening for a while, but we've really seen a significant increase in the prices of those commodities over really the last year. But if we look at the 2-year gold price, you can see that it's up about 150%. If we look at the silver price, it's increased almost 250% over the last 2 years. And this is something that has caught a lot of people off guard. And we'd like to talk through a little bit about what's going on here and why we think this is occurring. So, Josh, can you dive into that topic for us a little bit and explain why we believe this is occurring and talk through kind of when all this began?
It's an interesting question, Max. So, really, like many of these events, it starts long before we actually saw the price go up. So, if many of you guys remember, if you were been clients for a while, you might have listened to our quarterly Beyond the Noise episode when we talked about the invasion of Ukraine by Russia. Some of the things that occurred as a result of the invasion, the U.S. invoked sanctions. But the other thing that the U.S. did, which was an unprecedented move, was to actually seek to weaponize the banking system, specifically the SWIFT system. And they did that by ultimately freezing Russian assets, specifically dollars and US government bonds. So about $600 billion of Russian assets they were not able to access because the US weaponized their control of the banking system. And if you remember at the time, we predicted that this would ultimately change the way many countries around the world think about the reserves that they hold on their books. Because if you cross the US, if you're an enemy, or even if you're someone who might potentially engage in a smaller level conflict, this is a tool that could be used against you. And so, one of the things that countries that are not friendly to the US or even enemies of the US are looking at as they're watching this, specifically China, is how helpful are US currency reserves? During good times, yes, it's helpful for transacting business. But in the event that we come in conflict with the US has a lot of power to be able to freeze a lot of US held assets. And so for a country like China that holds over $3.2 trillion of currency reserves, much of which is US dollars, they've got to be asking themselves the question, if we ever want to take Taiwan or do anything else that the US doesn't like, we've got to become sanction proof. And one of the things that is not going to help them be sanction proof is holding a lot of US dollars that ultimately the US can simply say, we're freezing. Sure enough, if we were to look at the purchases of gold by central banks, you can see for about 10 years going before 2022, the number ends up averaging about 450 to 500 tons of gold a year that the central banks were purchasing. What happens in 2022? It skyrockets and it doesn't drop. It goes to above 1,000 tons of gold every year in 22, 23, 24, and it also occurred in 25. We do not anticipate that this is a trend that will change anytime soon. Because of that move, the US has made themselves a much less desirable place to store a foreign country's reserves. So we would argue that is by far the largest reason that has resulted in gold prices specifically moving up. A secondary reason has been the fact that for really the first time in years, in decades, the US's solvency has actually been called into question. We're no longer AAA rated by any of the major rating agencies, and people are insisting on a higher yield than what the Fed funds rate ultimately ends up being. So that we'd argue that that's a second reason. And then a third reason, by far less significant, has been the fact that we've just seen a larger industrial need for both gold and silver and more electronic equipment with AI and other things that have been progressing with it. There's actually the one last thing that we wanted to point out, which is just speculation. Anytime you have an asset that begins to dramatically have high returns, you oftentimes see a lot of speculators jump on board. And I think one of the greatest proofs that that's the case with gold and silver is about a month ago, there was a single day where silver prices fell 30%. And gold got hit as well, about 13 to 15% drop as well. So, anyways, I think it's just important to recognize those are the four, in our opinion, the four major factors that have resulted in gold and silver prices moving up as much as they have over the last roughly 2 years.
Yeah, it'll be interesting to see how all of that plays out. The speculation is one of the things that's most interesting to me. You can see a lot of people get in right here at the peak before you can see some real big drops. Well, let's move on and talk about our projections and trends that we see playing out in 2026. There are 8 of them that we're going to be going through. And the first one is that we anticipate we will continue to see declining federal funds interest rates. Let's step back and talk about what the federal funds interest rate is, and then we'll get into details of kind of our projection for this year. So when we think about the federal funds interest rate, think of it as the rate at which the Federal Reserve Bank loans money overnight to other banks. So it tends to be loans that are very safe and they're very short term. And this rate can influence longer term rates. Think rates like the 10-year Treasury or the 30-year Treasury, but they don't necessarily move in complete one-for-one correlation. When we think about the federal funds rate, that tends to impact things like commercial real estate. It can impact things like buying and selling of businesses. And we'll talk more about that in the future. Longer term rates, like the 10-year Treasury specifically, have more influence on residential mortgages and those types of things. Those rates tend to influence mortgages a little bit more closely. So when we talk about the Fed lowering rates, we're specifically talking about the federal funds interest rate. And it's really the only direct rate that they have control over. And you can see that over the last couple of years, we were sitting right about 5.5, and we've seen a decline to about 3.75 there at the end of 2025. And we're anticipating additional cuts between now and the end of this coming year. Now, that will be somewhat influenced by who ultimately gets appointed as the successor to Jerome Powell as the chair of the Federal Reserve Board. As many of you guys might have seen, Kevin Warsh was recently nominated by Trump to take over that role, and it looks like he will likely be approved or confirmed by the Senate, but we'll have to see how all that plays out. There's some headbutting going on between various members of the government, but we'll see how all that plays out. Now, Kevin Warsh has been a real proponent of cutting interest rates, so we do anticipate that that will continue to play out, but there are some other complicating factors that we'll talk about in a little bit. Now, Josh and Laura, I'd like to bring you guys in. What do you anticipate being the number of cuts, or how much do you think we'll see federal funds interest rates drop this year?
This year, the market is pricing two cuts, and specifically 2 quarter point cuts. So basically reducing the Fed funds rate by about 0.5%. So the market can and has been wrong in the past. We actually think that there may be a chance that we see more than just the 0.5% that the market is actually pricing in. And specifically, if Warsh is approved, we tend to think that that's more likely than not. Why? Because while Warsh is in favor of lowering rates, he's also in favor of actually reducing the amount of money that the central bank has injected into the economy. Specifically, after COVID, there was over $4.5 trillion injected into the financial system. And over the last several years, the central bank has reduced that by about $2 to $2.5 trillion. He is in favor of continuing to reduce that. When you do that, it tends to actually cause deflation. And so I suspect that there's a chance that you could see the central bank, if they do tighten like he's suggesting, actually potentially have more rate cuts than is originally anticipated being. And we've actually seen a number of public officials more closely tied to Secretary Bessent and others that have suggested that that may be a possibility as well. So we would say 0.5% is a good base case, but we think there's actually a decent probability that we see a higher number of that. The obvious bear case there would be if we see inflation tick up. And if inflation ticks up, we would actually expect that we could actually see less. But I think the more likely base case is 0.5% with a good probability of more.
And we have seen inflation kind of stay around the same level and decrease a little bit over the last 6 months, right? So um, I think that also leads to your point, Josh.
Yeah, absolutely. And I think as Josh was talking about, Kevin Warsh is somebody who has been a big proponent of combating inflation and pulling inflation down. So if that continues, fantastic. If it doesn't, he's going to really hit that pretty hard, which is again kind of that bear case that you're talking about there, Josh. Well, this kind of ties very closely into our second point, which has to do with the federal funds or with the Federal Reserve's balance sheet and specifically quantitative easing. So, Laura, our projection for this year is that quantitative easing is going to continue through mid-May. Mid-May is the point at which Jerome Powell's term ends, and most likely Kevin Warsh ends up taking over. Talk to us a little bit about what quantitative easing is, Laura, and why we anticipate this continuing through mid-May.
Yeah, Max, as you mentioned, the Fed has a couple of different levers that they can pull to influence economic activity. The first is increasing or decreasing the interest rate, the Fed funds rate. And the second, as Josh mentioned, is quantitative tightening or quantitative easing, which is just a really fancy way of saying putting money in or taking money out of the economy. The way that they engage in quantitative easing is by being an active participant in the purchase of bonds on the market. This is typically done through purchasing US Treasuries, but in during COVID, when we see this gigantic spike of trillions of dollars injected into the economy, they also purchase mortgage-backed securities and in some cases corporate bonds. But normally, under the mandate of quantitative easing, it's usually in the purchase of treasuries. So if we look at kind of the tail end of this chart, in 2025, we actually went through, really starting in 2023, we went through what has been a long quantitative tightening cycle. And as Josh mentioned, the Fed has been able to reduce the balance sheet by quite a bit over the last 2.5 years or so. And that cycle ended in November. And pretty immediately, they went right back into a cycle of quantitative easing. From December 12th to January 14th, the Fed purchased about $54 billion worth of treasuries. The current easing cycle mandate is to purchase about 40 billion per month, to allow repayments, so treasuries coming due, to be reinvested based on discretion. So they can either let that roll off the balance sheet and basically digitally destroy it, or reinvest it into the purchase of more treasuries. So over the next, basically from January to mid-May, we expect that the Fed will increase their balance sheet by about 200 to 250 billion dollars. But to the point that you just made, Max, with Kevin Warsh coming in, I think it's going to be interesting to see if he moves right into a tightening cycle. He has been very vocal about the fact that that is one of his biggest goals is to decrease the Fed's balance sheet. And so we might have a situation where you kind of have a gas pedal with the decrease of Fed funds rate and kind of a brake pedal with the decrease of the balance sheet. So I think that'll be interesting.
Gotcha. So essentially, what we're talking about here is as the Fed's balance sheet increases, that tends to be a effectively they're buying bonds and putting money into the market. And as you go the other direction and reduce the balance sheet, you tend to be in a position where you are taking money out of the market, and it tends to be a bit of a headwind. So it'll be interesting to see how that plays out. I think you're right. Kevin Warsh, again, as we've talked about many times, is going to be kind of the big wild card here. So we'll see how all that continues. Now, one of the things that we've talked about here that's it has to do with decreasing interest rates. And specifically, what we're going to be looking at here next is the impact of decreasing the Fed funds rate. And so as we kind of look into our third trend or projection for the year, we are of the belief that real estate, and specifically commercial real estate, is likely going to begin to thaw. So, Josh, I'd love for you to walk through a little bit with us why we believe this is the case, probably looking back several years as to what's been going on with the real estate market and what we anticipate happening this year.
Yeah, so when it comes to commercial real estate, what are we talking about? We're talking about apartment complexes. We're talking about industrial warehouses, self-storage facilities, office retail. Um, when inflation, so first off, what caused this to be in basically the icy territory we're in right now? It came back to the spike of inflation in 2021 and 2022. The central bank responds by dramatically increasing interest rates by 5%, and it brings the entire US real estate market to a grinding halt. Not only does it bring the purchase of new real estate or old real estate to a halt, it also brings new construction starts to a grinding halt. And that's really where our story begins. Because in 2022, we had a good number of construction starts. And then in 2023, and you can see this, we've shown charts here of four different areas, new construction falls off the cliff. And we see close to depending, areas like industrial and apartments, we see a 70 to an 80% decline in new construction for these areas. Why is that significant? Most commercial construction, specifically in areas like apartments and industrial, but also in many others, it's not a simple process of, okay, I'm going to build and the building's going to be ready in a year. In many cases, it can take 2 to 3 years for that new building to actually get the financing lined up, the permitting completed, and the actual full-scale construction done where it can actually be an occupied building. And so, what's the point? That means that construction that was started in 2020 didn't ultimately hit the market until 2022 or 2023. Things that started in 2021 didn't hit the market until 2023 and 24. Things that started in 22 didn't actually hit the market until 24 and 25. Once again, when did the big drop off occur? 2023. So 2023, when would you expect that construction to hit the market? 26, this year. So this will be the first year where we see the impact of much lower supply actually hitting the market right now. And so we anticipate that, and real estate is very much a local market game. So we're making a national prediction that we think that the national market will begin to dethaw significantly this year. But you will have certain markets where rental rates have been dropping, where we think that you will either see that drop be less or even stabilize. We think you'll see some markets where you've begun to see rates stabilize, actually start to increase. And you'll see markets where things are already increase more rapidly. Why? Because the amount of new competition that is going to enter the markets is going to be dramatically less for the next 3 years. So that's the kind of the first thing. The second thing, which Max alluded to earlier, is that the Fed funds rate is the most direct link to what the cost of financing a commercial real estate building is. So last year we saw a roughly 0.75% drop in the Fed funds rate. We're expecting another 0.5%, maybe more this year. That means for individuals who were looking to buy a building 18 months ago versus probably by summer, they're going to be looking at almost a 1.25% difference in the cost that it takes to finance and purchase a commercial building. And so between these two bigger things, we expect to see the real estate market start to thaw in 2026.
Yeah, Josh, it'll be interesting too, because as interest rates come down on the short end with the Fed funds rate, that tends to promote buyers, right? And increases demand at the same time. So we're in an environment where you're getting a double whammy, so to speak, right? Where we're seeing new supply really cool down and we're seeing demand start to pick up. So I think that's just a further contributing factor to real estate beginning to thaw this year. Now, another impact that declining federal funds interest rates has is on capital markets and IPOs. And so our fourth projection for this year is that we anticipate seeing a reopening of the capital markets, which have been very muted over the last couple of years, and IPOs, which is initial public offering. So companies going from a private company listing on the stock exchanges. Josh, talk to us a little bit about what the capital markets are, what we mean by that, and why we anticipate them reopening in this next year or two.
The capital markets is really just a fancy way of saying what is the overall environment for businesses choosing to be bought or sold, whether that be as a stock or whether that be in the private markets. So, our belief is that we are going to see 2026 be a year that is categorized by a dramatic increase in mergers and acquisitions, and then also in companies choosing to go public. So, to be clear, we originally expected that this would begin to start last year, but we had a little bit of a gleam of light that started, but then ultimately Trump made his announcement about Liberation Day, and so that basically shut down M&A really for about 3 quarters. The markets really wanted to know what's going to happen here. Are we going to, what are the specifics of a lot of these trade deals going to end up looking like? So we're at a point now where we've gotten past that, and so it's really starting in the fourth quarter. We began to see an uptick in the number of mergers and acquisitions that took place. We saw about a 58% increase in the number of new mergers and acquisitions over the fourth quarter of 2024. So that was kind of the beginnings of that, and we have continued to see that, and we think we will continue to see that here in 2026. So why is that the case? One, as we mentioned, same reason when private companies or even public companies are typically looking to purchase businesses, the cost for the financing that they pay is most closely related to the Fed funds rate. So the 0.75% drop that we saw last year definitely helped that. The anticipated additional 0.5% this year will also continue to help that. So the Fed funds rate is definitely going to be supportive of that kind of environment. And then the other reason we also believe that is right now, price earnings, and we'll talk about this more later, price earnings ratios are high. So companies can actually sell at higher multiples today than they could have, say, a year or even 2 years ago as well. So those are the big pieces. And then the last piece of that is the IPO market. The IPO market has been quite slow. You'll notice here in this chart in 2021, we saw a peak with over 1,000 companies going public. That number falls dramatically in 2022. We saw an uptick in 25, and we've already had 60 IPOs this year, just 2 months in. So we anticipate that we will see very strong IPO market activity and maybe even some famous ones. There's discussions of SpaceX potentially going public. There's also been rumors, I will underline rumors, about OpenAI or even Anthropic choosing to go public, two very large AI companies. And so we anticipate that those will be trends that categorize this year.
So, Josh, that's all interesting and makes a lot of sense. My question for you, though, is for our audience, for our clients, what impact does this have on them? I mean, how does this, why does this matter to them?
The merger and acquisition market is one of the lifebloods of the economy. You can think of it as a flywheel. It tends to pull a lot of things in and tends to make it much more strong. So why is that the case? So the banking industry benefits from the merger and acquisition market being strong. Why? Because they oftentimes are representatives and involved in the buying and selling of businesses. So they collect a lot of fees related to the buying and selling of companies. Private credit or even just general lending oftentimes gets repaid. If a company gets bought, all of its existing loans typically will get paid off, and new loans are brought in those cases to recapitalize the business in those cases. So private credit will be a beneficiary of that. Also, private equity companies will be beneficiaries of that as well, not only in terms of the selling of a company they already own, but as that money comes back, what are they typically going to do? They're going to return it to investors, and those investors are going to go out and be looking for additional opportunities along the way. So it's a bit of a virtuous cycle where when you have mergers and acquisitions, you tend to have more of the same that ultimately ends up occurring. And so there's a lot of industries, even on the private equity side, when a new company is purchased, there's usually a lot of innovating and slash modernizing of those businesses. And so that also can benefit a whole host of other vendors along the way. So there just tends to be a lot of people that benefit really positively. The last thing that I'll say is specifically from a stock market standpoint, this does not have to be limited to the private world. In fact, there's a good number of smaller public companies that may get purchased by another public company, or maybe they're taken private. They're taken out of the stock market and they're taken private. And usually when that happens, those purchases tend to be at 30, 40, 50% premiums to what they were previously listed on the market in order to justify leaving the market. So that also tends to be a pretty positive thing as well.
Yeah, just over the last year, we've seen a couple of big public mergers where we had Capital One merge with Discover or buy Discover. We had obviously SpaceX and XAI, which is not a public one, but we've got Netflix also potentially looking to purchase Warner Brothers. So some other big opportunities. And I also think that with IPOs picking up, as public market investors potentially have some exciting opportunities as well, right? If we end up seeing a SpaceX go public, hey, now we've got the opportunity to invest in Elon's vision for reaching Mars, building a self-sustaining city on the moon. So lots of opportunities. I mean, even OpenAI, if that ends up going public, now we've got access to a lot more exciting things that are occurring in the artificial intelligence world. And speaking of artificial intelligence, that ties in very closely to our next projection, which is for this coming year, we anticipate continued artificial intelligence capital expenditures, which is CapEx, and build out. We've seen a massive amount of growth in companies investing in infrastructure for AI. So Laura, talk to us a little bit about what we mean by CapEx, how that's grown and how it's expected to grow going forward and why that should matter to us.
Yes, if any of you guys were on our last Beyond the Noise webinar, we spent the whole time talking about AI, and this is one of the topics that we discussed. And so I kind of want to take a step back and look at 2024 and the CapEx or capital expenditure for the hyperscalers when it comes to their AI spending. So when we talk about hyperscalers, really we're looking at Alphabet, which is the parent company of Google, Amazon, Meta, Microsoft, and Oracle. So some of the biggest tech companies, the ones that we consider as our biggest tech companies in America. In 2024, their CapEx spending was $241 billion. This year, that number is expected to more than double to $557 billion. It's $500 billion is not an insignificant amount of money. And what's interesting is that that number is expected to continue to increase for the next couple of years. So over the next 3 years, they're expected to spend almost $2 trillion, a little under $2 trillion towards this AI build out. And what the biggest question is why? Why are they spending this much money? When you look at their CapEx budgets, 70 to 90% of their budget for capital expenditure over the next 3 years is for AI. And the reason, and this is something we talked about in our last webinar, is because they don't really have a choice. If these companies lose the AI race that they are all fighting in, it can be a truly extinction level event for them. One of the quotes that Josh shared last time was from Larry Page, who is one of the co-founders of Google. And he said he would rather go bankrupt than to lose this race. And I think that just goes to show the importance to these companies in the AI product they might be able to come up with. If one or two of these companies win the race, it could render the rest of them obsolete. We've seen them compete with each other, alongside each other, create similar but different products over the last couple of decades. But this race, they are truly fighting with each other to win. And again, I don't think that $2 trillion of spending is something that we should look away from. So I think it's going to be interesting to see how that actually plays out, their ability to build out an infrastructure, potentially use that CapEx for products and whatnot.
It's interesting when you think about the number $557 billion that's being spent by 5 companies here in the United States. To put that in a little perspective, that's roughly equivalent to the gross domestic product of Norway. So we're talking about a massive number.
Yeah.
And like you said, kind of one of the real questions and areas that we're looking to potentially see is this going to pay off? Is this going to be a beneficial thing? And that leads into our sixth projection for this coming year, which is we do anticipate that we're going to start to see shoots of a productivity boom begin to sprout. And what we mean by that is up until this point, we've really had AI be present largely in the form of a ChatGPT or a Gemini or, kind of these chat model type of AIs, which have certainly helped from a productivity standpoint, but they've not really transformed things up to this point in many specific cases. There's one in particular that I want to talk about where they have taken AI and they have customized it and applied it to a very specific issue that they were having, and it really benefited them. And we anticipate seeing more and more stories like these as AI continues to expand. The company I want to talk about here is C.H. Robinson. C.H. Robinson is one of the largest freight brokers around the world. They are almost they're expecting to have about $1 billion in revenue in this coming year. So very large company. They get about $600,000 or sorry, 600,000 requests for quotes each year for basically quotes for basically shipping something from another location. And C.H. Robinson is very well known for being kind of the middleman. They're connecting people that want to ship something with the people that actually have the trucks and the ships to make that happen. And when they get these requests for quotes, prior to implementing AI, they had about a 65% response rate. And one of the key reasons for that is it took somebody actually seeing that quote, doing the analysis, evaluating it. It could take up to 45 minutes to complete a quote and get it back to the entity that was requesting that quote. They then took an AI software essentially and brought it in and applied it to their specific situation, a very customized solution that instead of analyzing 3 or 4 or 5 different points, it analyzes hundreds of data points. So you end up with a more accurate quote, and they were able to respond to 100% of the requests. It took the time to provide a quote. It took the time down from, on the high end, 45 minutes to an average of 32 seconds. This is absolutely transformative. If you think about them getting over 600,000 quotes a year or requests for quotes a year, they were missing or not responding to over 200,000 requests for quotes. So if you're able to now effectively respond, we're in a position, or they're in a position, where they're able to have a significant increase in the amount of activity that they have in their business and the actual, freight that they're able to um, connect with those that need to ship it. So as we end up seeing AI applied to very specific cases like this is where we're able to see significant growth and opportunity and productivity increases. Now, I want to be very clear about this. We would describe this as shoots of productivity beginning to sprout. So I think this is going to be something that plays out more significantly over the next 3, 4, 5 years. But we do anticipate starting to see some of the AI applications in some of these larger companies really begin to make a difference. So that's something that we're anticipating to be positive coming out of the AI boom here in this coming year. Now, our seventh projection is one that it doesn't have that could where we could see AI potentially having a negative impact on some industries and stocks. And that projection is really that we believe the fear of AI replacing businesses has the potential to decimate certain industries or stocks. And we've actually seen this just recently over the last really month, but it kind of began about 3 or 4 months ago. And what we've seen just recently in one specific industry has to do with tech software, the tech software sector. So since its high back in October, we've seen that sector fall over 29%. This is through a night or two ago. Josh, talk to us about why that has occurred, and does this have the potential to kind of have some contagion to other industries or stocks?
Yeah, so at the end of the day, AI is an innovation, and people are hyper focused on what could this innovation ultimately destroy or replace. And so, specifically, we've seen software generally trending down here for about a year, but we had an acceleration of that really in the last 30 to 60 days with a major AI innovation taking place with Claude Workspace. We began to see these plugins that were able to be put in with that product that effectively created agents that could be used to do more routine tasks for individuals within a company. And so that innovation the question became, man, could this ultimately end up replacing a lot of the major softwares that we'd have to spend a large amount of money to actually have for different companies? And it's a very a justifiable question. I think there's two things that I'd like to point out here. First off, what has made software as a service businesses so powerful is that they usually have some very strong moats, meaning things that make it hard for competition to compete and it makes it difficult for people to switch. There's a high switching cost to go to a different person. And so, what AI is doing and already has done is some of the traditional moats that protected software companies from competitors are getting decimated. The things that kind of come to mind are things like the user interface, or specific having specialized product knowledge so that you create a workflow that works really well for a particular industry. A lot of those things don't have nearly as much value as they once did because a lot of what AI is transforming to is a more chat-based interface where you just say, I'd like to know this thing about five other things, and it just does it. And you don't have to have the industry knowledge necessary in order to be able to actually do that. So there are that's the first thing. Is that there's a legitimate there are certain moats that are being hit really, really, really hard. Now, and I think this is one of the flaws. I do tend to think that this sell-off is probably a little overblown, partially because not all of the moats, the competitive moats that are around these businesses are going away. There are probably 30-40% of these moats that will maybe even become stronger because of AI. One of those areas that comes to mind most specifically is proprietary data. As an example, if you happen to have very specific proprietary data about a particular industry and no one else has it, AI can't go scrape the internet and find it. You are the only one who owns it. That is a moat that still absolutely exists, and I would argue that there's some other ones that's the case for as well. But what we have seen with specifically with software is this is an industry average number of 29%, but we have seen some stocks that are down 50, 60, 70, 80% in the last 12 months because of what has happened. And so the last thing that I would point out is I do think that the general trend of what we've seen here is justified. Why? Because at the end of the day, and this is something that most investors don't realize, when you were looking at the price that a current stock is trading for, it is not based on where things are at today. It is based on what investors believe this stock is going to be doing over the next 5, 10, 15 years and the trajectory of the profits and the cash flows that that business generates. What AI does is it creates a lot more uncertainty about what's going to happen over the next 5, 10, and 15 years surrounding a lot of these software companies. So, as an example, a company like Salesforce has gone from trading at 30 times cash flow to trading for half of that. Is that reasonable? I think there's a reasonable case to be made for that. Not because I think Salesforce is going away tomorrow, but because the certainty of its growth and its dominance is not nearly as sure as it was, say, 4 years ago, as an example. And the last thing I'll mention is while we've been focusing on software, what our prediction here is that there will be other industries that will be seen, there will be other innovations that occur in AI this year that will result in other people questioning whether other industries are going to be massively disrupted. And we think when that happens, you will see similar volatility in the stocks that are impacted in those particular sectors.
Yeah, Josh, just to reinforce your point a little bit there about people paying less for the earnings or for these companies. You think about companies like Salesforce and others, it is not that we have seen their earnings impacted today, right? I mean, you've seen a lot of these actually just release their fourth quarter earnings, and they were very positive, and they were actually projecting future growth over the next year or two. What ultimately has happened is people have become less confident that those earnings will continue to be around 10, 15 years down.
Or continue to grow as quickly.
Or continue to grow as quickly. Exactly. Yeah, AI has the potential to replace some of these. Again, it's not certain at this point, but it is less. Investors are less confident that those earnings or growth will be where it was or where it has projected to be over the last couple of years. So it'll be interesting to see how this plays out with software in particular, but other areas as well. Now, Josh, you were talking about kind of valuations for companies, and that ties into our last projection for this year. If you've been a client of ours for really any time at all, you have probably heard us talk about price to earnings ratios. Specifically, this is a way that we measure how expensive or inexpensive a stock is. We're essentially comparing the price of a stock to the earnings that are being generated. And so what the chart here looks at is a cyclically adjusted, think of it kind of adjusting over the course of a 5-year rolling period, cyclically adjusted price to earnings ratio. It's called the CAPE or the Shiller PE ratio. This looks at the last 50 years. And you can see that currently we're sitting about 41 times earnings. So that means, to put in a little different context, it would take, if you were to buy, and by the way, this is for the S&P 500, if you were to buy the S&P 500 today, it's going to take you roughly, on a cyclically adjusted basis, 41 years to make back the price that you paid, just simply in the form of profits. This is the second highest we've ever been in history. The last time we were this high was back in right before the dot-com bubble in late 1999. So this is certainly high. And does it necessarily mean that we're positioned to see a decline? It doesn't necessarily mean that decline is imminent. I mean, we feel confident that at some point we will see this revert back to something lower, which is generally accompanied by a stock market decline. However, our projection for this year is that we anticipate it remaining high or getting higher, and that's primarily because people continue to be excited about the stock market. They continue to see some positive things occurring, and as people do that, without respect to what's happening from an earnings standpoint, you end up seeing price to earnings ratios increase. This is also specifically tied to AI. We've seen a lot of people get excited about AI, and we're seeing prices driven up, but we've not seen a lot from a profitability standpoint increase from those AI investments. Now, that could change obviously in the future, but our expectation for this year is that we will likely see P ratios remain high or get even higher as we proceed throughout the year. Now, we would describe the environment that we're in right now. Many of you guys have probably heard us use this analogy, but we would describe the environment we're in as a forest that has not seen water for a couple of years. Doesn't guarantee that a forest fire is going to occur, but it's certainly more susceptible to that occurring when sparks happen. So expect more volatility from the stock market, and that's why we have been communicating to you guys our cautious optimism as we proceed into the future. So that wraps up our projections for 2026. And as we close things out here, I want to spend a little bit of time bringing you guys behind the curtain into the way that we as the investment committee think about certain topics. While we've talked about 8 different factors here that we have pretty high confidence in for this coming year, there are other areas that we take more of a dynamic approach because things are always changing and there's lots of tension between certain factors that would suggest it goes this way and certain factors that would suggest it goes the other way. So it's a bit of a balancing act for us as an investment committee to make decisions about certain factors or items in the economy and in the markets. And the one particular topic that we want to look at today is inflation. And we certainly have to navigate a meaningful balancing act in the world of inflation. On the left-hand side, there's lots of areas that are inflationary, and on the right-hand side, there are areas that are deflationary as well. And so the ultimate question is, this year, what do we anticipate? Do we anticipate seeing inflation increase, stay the same, or go down? Josh, why don't you walk through for us what we as an investment committee are thinking about and kind of what our ultimate conclusion has been here about our expectations for inflation this year.
Yeah, so once again, these kinds of decisions are like a scale. There are multiple factors that would point towards deflationary activity, and there's others that would point towards inflationary. When we look at the inflationary side of that, we have things like tariffs, which, contrary to what some might believe, it is inflationary. Now, does it always result in inflation? No. And we would argue that in this last round of tariffs so far, the person who's actually paid the cost for the tariff, by and large, has been businesses themselves. The businesses have not chosen to pass on the cost increases and instead have chosen to see lower profit margins instead. But that is an inflationary piece on the scale. The second is interest rate cuts. When it's easier to borrow money, there's typically more money that is borrowed and more things that are bought. So that tends to be a more inflationary thing. Third, tax cuts. The tax cuts from last year are going to result in more money in consumers' pockets and therefore more money they can spend. Also, we know from Secretary Bessent that many people did not adjust their tax withholdings. So we are going through right now a tax refund cycle that's likely to be larger than normal. And so we're going to see a lot more money flowing as well. Third, unemployment. Unemployment is relatively low, which means you have more of your workforce working, more of your workforce earning, and therefore more of your workforce spending. So that tends to be inflationary as well. The last two things is a weaker dollar, and people know it. At the end of the day, we're not in a period of time where inflation is just kind of a slow, gradual cut. The dollar weakened by 9% last year overall, and consumers expect that. And as a result, people are less willing to hold on to their dollars and more likely to go spend them. So that'd be the second to last. And the final one is housing. Now, why housing for the last couple of years has actually been a more deflationary thing because in many markets, you have seen rental rates coming down. Once again, because of the amount of supply of new apartments and even new houses that were coming to market, and the fact that you had fewer people than normal willing to sell their homes. We expect, if it's not in 2026, it will be in 2027. We expect that trend to begin to reverse as fewer apartments come online, we expect that we will actually start to see rents actually go up, and therefore that be a more inflationary piece of the pie. On the right side, we have things like productivity increases through AI. Now, there's a huge question mark surrounding exactly how much do we get from this. That's one of the bigger things that are uncertain for us. But this would definitely be something that would be deflationary because if you can have AI applied to an area, you typically can do it more cheaply, and as a result, the expense of that item tends to go down. The rising cost of the federal debt also tends to be deflationary because that's more money that has to be just spent on interest, and that's less money that can go and purchase particular goods. And then the last thing, or the second really to last thing, is an aging population. An aging population historically tends to be a more deflationary trend. But the last thing, and this is something that Max brought up at the very beginning, is our new Fed chair. Our new Fed chair does introduce, I think most people expected Trump to have a very pro growth slash let's have this economy go boom. We want to see big things. We want it to grow a lot, so let's inject money and everything else. That is not what we got. I was honestly very surprised by Trump's Fed pick because we had someone who actually wanted to reduce the amount of money that the central bank had in the economy while also while lowering the Fed funds rate. So that's probably the most uncertain wild card right now is one, can Warsh get what he wants? And two, exactly how significant will he begin to withdraw money from the economy? Because that is going to be one of the most consistent factors. So if we exclude Warsh from the picture, just because there's a lot of uncertainty surrounding exactly what he's going to do, we would say our base case scenario is that inflation remains steady and maybe even creeps up by the end of the year. That's our base case scenario right now.
I think as I mentioned earlier, with wild cards like Warsh and other things that we can't predict right now, it's essential that we take a dynamic approach to this in the sense that we as an investment committee are meeting consistently and evaluating topics like this and many others to determine is new data that's coming out changing our perspective on these things? And if so, how does that impact the investments that we're making, the recommendations that we're making for you guys as our clients? And so that dynamic approach is extremely important in this ever-changing environment that we're in today, where information is very prevalent and constantly coming at us. So hopefully this gives you guys a little bit of picture and a little insight, a little peek behind the curtain about how we as the investment committee approach things, in particular with regard to specific complicated economic factors like inflation. Well, let's move into our question and answer time. Again, for those of you that have a question on your minds, please feel free to send them to max@thefoxalliance.com, and we'll do our best to get answers to those. The first one is a relatively easy one that I can answer, and it has to do with the price earnings ratios that we talked about earlier, the cyclically adjusted price earnings ratio. The question was, does that take inflation into consideration in those adjustments that it makes and in the calculations that are made there? And the answer is absolutely yes. Inflation is factored in there, and we're not artificially increasing profits because just inflation is coming into play. We're adjusting that to take inflation into consideration there. The second question that we have, I think, is a very good one, and it's really tied into something, Laura, that you were talking about just recently. And that was with the AI build out that we've seen. We've seen a significant amount of capital that has been poured into AI. Oracle, Google, others are putting a significant amount of money into that. So the question is, as we kind of already talked about, we've not seen a ton of benefit up to this point yet. Are we looking at a short to medium term bubble in that space because of the lack of benefit that we've seen from that investment?
Sure, that's a great question. I think it's difficult to look at the amount of money that they're spending and not have some hesitations or concerns about it. Um, One thing I want to do is kind of break down what a typical bubble really looks like. And this is something that we've actually broken down in previous Beyond the Noise webinars. We talked about the tech bubble and kind of dissecting what a recession might look like. Um, Bubbles are typically characterized by a few things. One is a incredibly large increase in prices that's usually unjustified and unsupported. And those prices usually go up based on fears of mania, euphoria, and greed in a lot of cases, and speculation, as Josh mentioned earlier. Um, and so if we think back to like the tech bubble as an example, the Nasdaq increased from 1995 to 2000 by 580%. In the year 1999, we had 500 internet company IPOs, and the Nasdaq's PE ratio was at 100. I think it's pretty safe to say there was a lot of euphoria and greed in the market. And a lot of those IPOs were companies they didn't have a single dollar of profit. Some of them didn't even have any revenue. They were just, I've got a great idea. Let's go public. Um, and the result of that bubble popping in 2000 was about a 2 year decline in the NASDAQ that equated to almost 70 to 80% price declines. So when we look at the AI hyperscalers specifically, right now, we've seen those companies have profit growth over the last 5 to 10 years that has been significantly higher than the average profit growth of the S&P 500. They've had sales growth that's been significantly higher than the average sales growth of the S&P 500. And something that you mentioned, I think it was Josh, we were talking about like forward price to earnings ratios. When you look at the current price of the hyperscalers versus their forward profit growth projections, they are right in line with the S&P, right around 20 to 25. So these companies aren't experiencing price increases based on euphoria. Now, that being said, I think it is going to be interesting to see how are these companies spending their money? And are what they're spending their money on, is it experiencing some sort of incredibly large increase in price or costs? Um, and so if we look at the data from like what is a typical bubble, it doesn't look very bubble-like in that sense right now. But I think to the point you made earlier, Max, if we don't see the result of profits increasing from the AI spending that they're doing, that could be a totally different story here in the future.
And I would just add two other things. One, so it's the hyperscalers are particularly problematic when you're analyzing them because they already have very profitable businesses and these businesses are continuing to grow. So just because you're seeing their profits grow does not mean that they're actually getting profit growth from AI spend. That is something that is, I think, a really important distinction. The second thing is, Laura's comments here specifically about the hyperscalers. There are a lot of tangential industries that have seen massive stock price growth in the last year to year and a half, that I would argue is a lot less justifiable. I think about there are certain companies in the nuclear energy area, as an example, that last year saw at one point as much as a 700 or 800% increase in price. Now they've come down to earth a little bit more, and they're more like at 400 or 500% growth after some pullbacks. But still, I do think that there is some euphoria surrounding some more of the tangential areas, and that exists within the market.
That's a really good point, Josh, because I think, when we think about the bubbles of the past, it's been kind of very sector specific. You had tech sector, housing sector. the AI, there is no like AI sector. You have a lot of companies that are either, like you said, tangential to AI or companies that are actually building AI products. And I think that's a really good point. Um, that's a really good point that you just made.
Yeah, I think ultimately it comes down to, particularly with the hyperscalers, but with others, are they going to be able to make a return on the amount of money that they're investing in this? And that's the real question mark at this point. You've got all of these companies investing as much as they are. We're just gonna have to wait and see. What's that famous quote that you tend to underestimate, or sorry, overestimate what a technology can do in the short term, but you tend to underestimate what it can do in the long term. And I think we have seen some of that euphoria here about, man, it's so exciting. We're going to see, AGI next year. Well, may not be next year, but we might see that at some point, and it has the potential to really benefit things. Now, Josh, you talked about something that ties in very closely to the next question, which I think is a very good one, and we talked a bit about it last time when we were talking about AI. But how does AI impact the energy sector? I mean, aren't we in a position where, as AI continues to grow, as we see this build out, doesn't it have the potential to do one of two things? One, it should probably be a tailwind for the energy sector, but are we going to be able to keep up with that?
The first point that is really crucial to understand is that when we say energy sector, most people think everything. And the energy sector is not one sector. It is a bunch of smaller areas. You have power generation. You have the oil and gas exploration area. You have the processing. You have the end product side. So that's one very important thing to distinguish from the beginning is that those are all very different. I would say when it comes to power generation specifically, there is very strong tailwinds from a growth standpoint there because at least at this point, AI is very energy intensive. And with the amount of demand that's there, we're likely to need a lot more of it in the upcoming years. But that does not necessarily mean that does not mean that the industry may be like some. I've heard some postulate that AI potentially could take away some of the boom bust cycles that we've seen in some of the commodities like natural gas and oil. And I don't think that that's necessarily true. And I mean, even if you just look at the price of oil over even the last 2 years, as AI started to increase, it's still swung a lot over that period of time. So I think the answer is yes in a general sense, AI will likely be a strong tailwind to the energy industry overall. But it is important just to understand where you're looking in the specific sub-businesses that they're operating in.
I think there's two other factors that could influence that too. One, as innovation continues to improve, we've
Yes.
seen with NVIDIA and others, uh, the next generation of these chips and of these GPUs are actually far more energy efficient. And hopefully they'll become even more so as time goes on, where
Well,
you're
and they
able,
have a massive motivation to, because
yes.
with how expensive they are, it's like, wow, okay, if there's a way we can dramatically decrease the cost, we can now be competitive in a different way for these individuals.
Well, that's one of the reasons that NVIDIA's performed so well. I was listening to an interview with Jensen Huang, the CEO of NVIDIA recently, and he said that because their chip is more energy efficient than all the other competitors, they could give their chip away. Or sorry, I should rephrase that. The other companies could give
Competitor
their
could give
chip
away
away.
their chips away.
Competitors could give their chips away, and they would still buy the NVIDIA chip because on a net basis, they're saving money using the NVIDIA chip. So if we see more and more things like that occur, that's beneficial. The second thing is we're starting to see some real thinking outside the box with um, Elon and SpaceX talking about putting data centers in space, right? They just announced that, where if you're able to put a data center up in space, you have essentially unlimited energy, complete cooling technology there. It's an environment that is potentially very valuable, and that's not something that's going to occur for many years, but it is
Yeah, there's some substantial engineering breakthroughs that need to be made. Obviously,
absolutely.
if you were gonna believe that someone could do it, Elon is probably that person. But there are challenges that need to be worked
There
through.
are absolutely hurdles that have to be overcome, but there are ways that we could see energy be less of a uh, hurdle that we have to jump over from a AI standpoint going into the future. So, great questions, everyone. We appreciate your time and attention. We're coming up on time here. As always, we are grateful that you guys chose to join us this afternoon. Um, we hope that you guys have a great week, and we look forward to you guys joining us again on our next presentation. Have a great day.